Good afternoon, this is Byron Slessor speaking. I'm a Distribution Director at Channel Capital. Channel Capital are the responsible entity distribution and non-investment services partner to Sage Capital. And on behalf of Channel Capital and Sage Capital, I'd like to welcome you all to this webinar this afternoon. We really appreciate you taking the time out of your schedules and hope that yourselves and your families have been keeping safe during this very unusual time. So for those that are less familiar with Sage Capital, Sage was founded in Sydney in 2019 by Sean Fenton, and they're a long-short Australian equities investment manager that offer two strategies: a market-neutral Australian equities strategy that's designed to generate returns regardless of the direction of equities markets, and an equity plus 150-50 long-short Australian equities strategy. Sage believe that markets are complex and dynamic and respond to a large range of inputs. And they also believe that investors inherently display behavioural biases that a style-neutral process can exploit. So Sage seek to deliver this style-neutral investment process by utilising both quantitative and fundamental inputs equally in constructing an investment portfolio. So many investors will tell you that they utilise a style-neutral investment approach, but we believe that by equally weighting a portfolio with quantitative inputs to give a portfolio breadth, as well as fundamental inputs to give a portfolio depth of analysis, allows Sage to truly offer a style-neutral investment portfolio. So we've got two speakers this afternoon, CIO and founder of Sage Capital, Sean Fenton, and portfolio manager, James Delaney. So to introduce Sean briefly first, Sean will be well known to many of you. He's arguably one of the most experienced long-short Australian equities investors in Australia. Sean has been in investment markets for over 20 years. Most recently, he was the lead portfolio manager of the Tribeca Alpha Plus strategy, which is a 150-50 long-short Australian equities strategy for over 13 years. It was a first quartile performing strategy over the life of that strategy. It was well rated by the institutional, retail and wholesale network, and was hard closed with over $1 billion in assets under management for many years. James Delaney is a portfolio manager, as I mentioned, for Sage Capital. James has got over 12 years of experience in investment markets, most recently working alongside Sean at Tribeca for 5 years, and prior to that at Frontier Advisors and Matisk. James is focused more on the bottom-up research side of the portfolio. Sage, as Sean and James will touch on, divide responsibilities into quantitative and fundamental research. So to touch on the performance of the strategies, albeit over a relatively short track record, both strategies have performed exceptionally well under some truly amazing conditions since launching in August last year. So you can see the alpha generation of both strategies there. I guess what we've been most proud of is the volatility of the strategies, particularly the absolute return fund. It targets 8 to 10% per annum volatility, and you can see there it's at the lower end of that range at 8.2%. But also the strategies have been able to deliver outperformance in both down markets and up markets, not just relying on the rebound in equities markets since late March, early April to generate these returns. But without any further ado, I'll kick off with Sean and James. Thank you, guys.
Thanks, Byron, and thanks everyone for joining us and taking some time out of your lunch hours. So I'll just give you a very brief overview. Byron's already touched on it already in terms of the structure of our investment process, what we're trying to achieve, and then hopefully we'll get into some more interesting details, just looking at some of the stock opportunities we're seeing across the Australian market at the moment. So as Byron mentioned, it's worth highlighting one of the core focuses of our approach is diversification. And that diversification comes both across our investment process. So we've got a very broad-based investment process around picking stocks, including both broad quantitative research as well as insightful in-depth fundamental analysis. And we've also got a very strong emphasis on diversification in our positions across the portfolio, which is very important in terms of risk control and portfolio construction. So both our funds have a long-short structure. So equity plus fund, 150-50, 50% short, 150% long. And the absolute return fund can be up to 200 long, 200 short. Those long-short structures mean that we can have a very broad range of active positions, get a lot of different stock ideas into the portfolio. So that diversification is really what enables us to deliver strong, consistent returns in different market cycles, different market environments, and gives us immunity to some of the shocks that that come through the markets that we've seen. So just touching in a little bit more detail that investment process. As I mentioned, the quantitative approach, that's all about exploiting behavioural biases that exist in the market. We rank stocks across a range of factors from momentum, value and quality, and gives us a very broad, consistent ranking of stocks across the ASX 200. So that forms a very strong foundation and platform for our investment process. Immediately gives us some very objective insight and a very proven investment process that's been operating that quant model live for well over 20 years. We do recognise the fact that there's a lot of information available out there in the market beyond a quant process, and the opportunity to add value there from the fundamental side is very material. So we've got a very diverse, talented teams, as well as James sitting next to me, Kelly Maher on the fundamental side, and Peter Moore on the quantitative side. So we spend a lot of time meeting companies, understanding how they make their money, what makes them tick, what their advantages are, and importantly, recognising when some of those things can change within the market and provide real investment opportunities. So combining the two of those together gives us a lot of breadth and objectivity, as well as a lot of in-depth insight in terms of how companies operate, where investment opportunities lie. And as I already mentioned, we've got a very strong emphasis on portfolio construction, being style neutral, stripping out exposure to broad macro shocks, as well as having a very liquid portfolio with a lot of diversification across stocks, meaning that we're really focused on our investment process being repeatable, generating good stock ideas, and being able to deliver that consistently through time. So, with the boring bits out of the way there, what I'd like to do is focus on a couple of the core thematics that have really been driving markets and are likely to drive markets going forward as well. So the first of those is, it's been very perplexing for many, and it's certainly easy in hindsight to look back and see markets are recovered from a shocking collapse through March to, in many cases, stocks trading at new record highs. Certainly growth areas, technology, the Nasdaq trading at record highs. And you would have had to been living under a rock not to realise that central bank stimulus, money printing, the injection of liquidity, as well as a lot of fiscal support, has gone a long way to actually driving that rebound in markets. So central banks have been quite vital in terms of certainly lessons learnt through the global financial crisis in terms of what they need to do to inject money and drive markets there. So that's been important in driving markets back up, but it's also been very important in terms of who have been the winners and losers in a relative sense, and that's what we're really interested in terms of investors in the Aussie market. So it's worth noting that that strong liquidity, easy money, as we mentioned, it's found its way into technology and growth stocks. That actually makes a lot of sense when central banks are out there cutting cash rates to zero, controlling yield curves, flattening out yield curves, directly buying bonds. That drive down in discount rates makes anything that's got growth incrementally more valuable. It also makes things like hard assets like gold, anything that's got a limited supply when every central bank around the world's printing money, then certainly those sort of assets do well. And also you've seen the impact of government stimulus out there. So the interesting thing about that, and some of you might have seen some work we did here already, is just the way this financial repression, this money printing, drives relative winners and losers across the market. So whilst it's tempting to call the Nasdaq a bubble, buy now, pay later stocks a bubble, the broad technology space a bit of a bubble, there's actually a fair bit of rationality in terms of investment decision making that's occurring there. So what we've got on this chart on the right here is just showing the trade-off in terms of valuation outcomes, in terms of how dropping discount rates down makes growth stocks incrementally more valuable. So we've got an example of two stocks here, one that's got a growth rate into perpetuity of 2.5%, one that's got a growth rate into perpetuity of 5%. So for argument, this is a very simplified example. Let's assume they've both got the same risk characteristics. But as your discount rate, your risk-free rate bond yields collapse down towards zero, the PE that you're prepared to pay for that growth stock starts increasing exponentially. And we can see this observed in the market in many ways. So those technology stocks, as I mentioned, healthcare, anything that's been got good, strong, stable growth there becomes incrementally more valuable. So it's important to recognise that firstly, not to fight it in terms of being too anchored around historic valuation levels. And we do that very importantly in terms of the way we look at the market, the way we neutralise different sectors. So one of the most important things we do is we group a lot of those growth stocks into a similar bucket. We're really looking for, say, the best opportunities within growth stocks. We group cyclicals and value stocks into the same bucket so that we're not getting caught into some of the style dynamics and the broad risk thematics that are being driven by central banks. That said, certainly bubbles can form in this environment where a lot of liquidity is chasing. Fundamentals actually drive a re-rating, and that can follow on as well. So it doesn't mean you can just throw valuation out the window and buy anything as well. The other interesting dynamic that's worth focusing on, particularly as we look forward and where markets are going, is what this means for market volatility and dynamics going forward. Because we're down on this part of the valuation curve where things are becoming a bit non-linear, when bond yields turn around, if we get some good news in markets, if you start to see stronger growth, bond yields sell off a little bit, central banks actually pull back on some of the liquidity, and the Fed's just starting to taper a little bit in terms of its bond purchases now. This could actually prompt a fair bit of volatility in the market. It won't take much of a backup in bond yields to create absolute mayhem across the whole tech space, the whole high growth space. So this isn't something that you can just pin your ears back and go along and stay long. On
this chart too, Sean, I'd highlight that what we're seeing across the sell side is over the last sort of 6 months to probably 24 months is a lot of them used a fixed risk-free rate in the valuation models. 2.5%, 3% was the standard they used over a long period of time. And over the last 12 months, to keep up with stock price valuations, they're actually slowly dropping their risk-free rate, increasing the DCF valuation on a lot of their stocks. And that's not something we do here at Sage. We actually use just the market bond rate when we actually value these names, because that's the way the market's looking at the stocks. And as we're sort of looking at it from a style neutral perspective, we are looking at relative choices between those different sectors. And we're going to discuss one of those just coming up now.
Yeah, it's good. So I'll hand over to James here, but what we're just going to focus on is just a stock, one of our preferred overweights and underweights, longs and shorts within the growth space. So James, talk us through Appen.
Yeah, so Appen is the biggest global player in AI data annotation. So what that really means is that they're providing the human annotated data for Facebook, Google, voice recognition in your car, for any sort of AI system algorithm that's constantly learning over time. And that really has been a constant progress at all these major tech companies, Western tech companies in particular, for Appen's client base. So they will provide large data sets, correlate the data, and provide that data to actually train the AI models at many of those major companies. And this has just been an absolutely growing market over the past probably 5 years, and it's forecast to grow at a really strong growth rate over the next 5 years. So some forecasts we've got there from a few different research houses suggest that 30 to 40% growth here from the AI market to $165 billion by 2025. And just on the right-hand side, we've got the graph there, what that translates to in terms of AI data spend. And you can just see a constant growth in this market. And sort of, if you look at Appen's organic growth rate over the past 5 years, it has made some smart acquisitions that have really supercharged that. But if you strip all of that out, it's still growing at 30% per annum year on year. And all of that pleasingly is dropping to the bottom line. And being the biggest player in the market, they're sort of building on the competitive strengths over time. They've got access to 5 times the amount of data that their nearest competitor, Lionbridge, has. And they're using that to train their own tools, and their proprietary tools connect their cloud to their major client base. And as more and more data gets processed through that system, they're actually learning and becoming more efficient and picking up on certain things. So it really gives them a pricing advantage over many of their peers in the space. Not only are they the biggest player in the market, but they seem to be consolidating the space. So, it's a stock we really like and we've held since inception, continues to perform well. We actually held it previously at Tribeca as well. Near term, what we're really excited about is the US election and what that means for the social media platforms. The social media platforms are obviously a big client. Facebook is one of Appen's biggest clients. And last election, there was the Cambridge Analytica scandal that was really because Facebook dropped the ball on monitoring a lot of its current sort of algorithms and what they were picking up, and they were exploited by political interest groups. So going into the US election, the second half of the year, we expect to see a really strong demand from those major clients of Appen.
The other thing I think we like about Appen is it's a real company with very solid earnings bases. So it does, for a growth stock, it actually doesn't look overly expensive. Its PE multiples would be...
its PE multiples have expanded quite a lot in the last little period, but they're still sort of at 47 times. It seems extreme, but we're going to talk about a name that coming up right next that actually has a PE multiple in excess of Appen and hasn't really generated the growth that anyone's been expecting over the past 5 years.
Yeah, so as we mentioned, yes, certainly falling bond yields have driven Appen's PE up, as with the whole growth universe. Another company who's had its PE driven up with the growth universe is Seek. Seek's been a long-term growth stock, if you like. So if you look at that chart on the right-hand side there, it's been a major beneficiary of the broad transition of print to online. So specifically capturing job ads, employment advertisements, taking them out of newspapers, putting them to an online portal. And you can see that very strong growth from the early 2000s, interrupted by the GFC. So bear in mind, employment does have a cyclical element there, and continued to grow very strongly out into 2015. But you can see there on that chart, and just to explain that chart, what that is consensus earnings forecast for each year and how they've been revised through time. So you can see from 2015, consensus earnings and actual reported earnings for the company haven't really grown, and the company's been beset by a series of downgrades. And then with the onset of the coronavirus crisis, those downgrades have really accelerated. So as I mentioned, being a growth stock, it does also have a high cyclical component. So what happened around 2015? Well, for one thing, you've sort of had the maturation of that migration from print to online. So the underlying growth from actually capturing more of the market has gone away. And you've also had increased competition within that market. So you've had the emergence of LinkedIn, some aggregator sites like Indeed.com, which has started to put pressure on the ability for that core employment business to grow. So Seek's were invested heavily looking for new sources of growth with new startups going offshore. They've had some success in China with the Xiaopin, although some of the very strong revenue growth there with their new freemium model hasn't really translated into bottom line growth or even at the EBITDA level. So the company where it sits now is actually looking quite fully valued in terms of certainly near term, but even looking out for a recovery in earnings. It's got one of the higher multiples in the market. Its balance sheet is reasonably highly geared, as it's they've been reinvesting, looking for growth quite aggressively, and have needed to get some waivers of covenants to avoid raising capital in the short term. So there's certainly some positives, and the positive view out there is the ability for them to go out and reprice advertising more aggressively. So looking at more value added, so getting higher pricing for higher paying jobs. That's been a common trend amongst those domestic those portals, as well as lifting overall ad rates. That said, though, they've got to really do a lot to actually justify the multiples that are in there in the price. So this is an example of a company. If you look at the share price, it's actually trading near its relative highs. But what we look for in the market here in terms of when we set up our longs and shorts isn't necessarily got to be a stock that falls in absolute terms, but we're certainly looking to make money within the sector and the relative performance within the sector. So that real big drop in bond yields has lifted the valuation of all growth stocks. It's very hard to find growth stocks that have underperformed over the last decade, just with the big tailwind lift from falling bond rates. So within this sector, we're looking for really identifying what are the underlying earnings doing for these companies. So James, do you want to talk us through this chart that we've got here?
Yes, this is just the relative performance of Appen and Seek over the past 2 years. And Seek has sort of been facing, as just Sean pointed out, EPS downgrades over that period of time, where consensus expectations are being wound back. That's been offset to some degree by the lowering of the overall bond rate and constant QE that has inflated the valuation. So although the earnings have been downgraded, the valuation hasn't actually moved for the stock and still trading at even higher PEs than it was previously due to those downgrades. Now, on the other side, we've got Appen. That's a stock that's continually growing its EPS. It has done two things. It's actually re-rated upwards due to the falling bond rate, but also grown its EPS over time quite considerably. And the gap between these two names just becomes stronger and stronger as one continues to generate EPS growth, trading at, even if it holds its multiple, trading at the same multiple with the long-term growth profile. The other one continues to benefit from lower bond rates, but unless it actually generates some meaningful EPS growth, the stock price just lags, and that's what that chart here is showing.
Yeah. So the key within this sector, the growth sector, is not really to focus on valuation. We find that within our quant analysis as well, but valuation is not a very particularly strong driver here. So interestingly, from the quant side as well, even if I just go back to this previous chart. So within our quant model here, it will be looking at some of these earnings trends and revisions trends. So from a momentum and earnings momentum and even relative price momentum within the sector, Seek is going to rank quite poorly within that space. And because its earnings have been falling relative to a price going up, its valuation stretched as well. So Seek actually on our quant process ranks quite poorly. But even on a fundamental point of view, we view Appen as being a little bit cheaper than Seek. That's not really important. What we're really looking for, both from a quant and fundamental perspective within this sector, is really which companies are going to deliver the most earnings growth over time in the growth space. And the trends that we've seen in recent years between the two, we see them, if anything, the divergence accelerating going forward rather than narrowing at all.
I'd also argue too that Appen's becoming over time a better quality business with greater barriers against some of its competitors.
Yep, more repeatable earnings growth. So we've probably belaboured the point there. So let's move on and look a little bit more on one of the other thematics that we wanted to touch on in terms of dislocations, opportunities opening up within the equity market. So we won't bore you to death with a run through of coronavirus and what's happening there, but needless to say, there's been enormous cyclical impacts, but we think quite likely some longer term structural impacts arising out of this whole global pandemic. So once again, they're reasonably obvious. You've only got to pick up a newspaper to find them, but there's been an acceleration of existing trends. So certainly with a lot of physical stores closed, there's been a big shift to spending online and online retailing. And that's been very beneficial to certainly some of the larger listed retailers that were already investing in terms of online offerings, home delivery, the logistics that sit behind there. They've had the capability to actually meet consumer demands there and have done very well. And there's many cases, surprisingly, and what's one of the biggest economic shocks since the Great Depression, discretionary retail is actually experiencing very strong growth and booming profits. So certainly being in the right space as well. So as well as a structural shift to online trading, businesses moving more into the cloud, more SaaS models developing. There's certainly a shift in spending patterns as well. So with a lot of businesses closed and locked down, everything from restaurants, pubs, clubs, cafes, been obviously a big impact on tourism, big impacts through migration as well, have impacted a lot of businesses. So there's a lot of money not being spent in the economy in those areas, but it's being redirected to other places. So anyone who's benefited from home office setups, obviously the move more electronics, gaming, entertainment, anything in terms of home improvement. People have been spending more time at home doing the home up, have actually benefited from a bit of a lift in spending. So there's an interesting combination of structural and cyclical effects going on there that you need to be aware of when looking at potential investments. Obviously, this won't last forever. You're already seeing quite a high degree of adaptation to the virus. So there's, despite a clear second wave, not just in Australia and in Victoria, but around the world, a re-acceleration of infections, there's a real resistance to have broad national lockdowns and shutdowns. So there's already a degree of adaptation occurring there, which means you don't want to get caught up in too many of those cyclical impacts, because they may start reversing over the next year or so. But we want to focus certainly on some of the structural impacts as well. So as I mentioned, some of those structural online shoppings, one of the other major structural impacts is around working from home. So there's more evidence emerging that CBD office space is in less demand. Some reasonably large companies are letting whole buildings to floors of office space going, and you can see that most directly in a few office REITs looking to diversify into investing in industrial and data centres, which is a fair indication of where they see demand going for office space. So that's something certainly to be aware of, but also the implications of what that means in terms of commuting, demand for public transport. We've seen a big surge in demand for second-hand cars. It's likely to be maintained for a while. What that means in terms of demand for telecommunications, working from home, but also the flow-on effect to businesses that are based around the CBD. We really haven't seen some of these impacts hit at the moment. You've got a lot of government stimulus out there, obviously job seekers. A lot of loan
deferral as well going around.
A lot of loan deferral, that's very important. So we'll touch on a little bit in a second, but the banks are engaging in an amazing amount of forbearance, strongly encouraged by the governments and supported by APRA in terms of the regulatory body. But the amount of mortgage deferrals, small business loan deferrals, personal loan deferrals out there are quite significant in terms of the book. What's not clear is how many of those are going to come back, cure and start normalising. So some of those deferrals are set to be extended even further out. What that creates is a level of uncertainty in the banking system, but it doesn't mean all those businesses, small businesses that have been impacted by some of these massive structural changes actually come back. So the risk with the banking sector, whilst mentioned there's some real winners and losers within the economy. The banking sector as a whole tends to have exposure to the losers. So if small businesses are going broke, if office valuations fall a long way and don't support loans behind them, if residential investors are in stress and need to liquidate properties, the bank's negatively exposed to all of that. If JB Hi-Fi sales are going through the roof, having better credit quality there at JB Hi-Fi doesn't help bank profitability. So when you get this massive shock to the economy in terms of structural change, a lot of cyclical change, that volatility, the winners and losers, are actually just negative for the banks. And
it's also one of the reasons you could argue why the Australian share market's actually underperformed other markets. It is our bank-heavy index.
Yeah, it is. So it's certainly worth bearing in mind that Australia's trailed certainly the US, the S&P, the NASDAQ, and a big portion of that, if you look at what just hasn't lifted, certainly our large financial sector, our large banking sector, with that more permanent or sort of longer term negative shock there. We've been talking about this for a while. It might be worth touching on just where we see some of those opportunities within our yield sector. So that incorporates not just the banks, but broader financial companies, fund managers, insurers and the like. These companies tend to be pretty highly correlated around that sort of risk. But we do see some relative winners and losers in that space where we can make some money for you guys, investors.
Yeah, so a sort of lesser known company and probably not an obvious choice for a structural winner from a recession like we're seeing at the moment is actually Credit Corp. Now, Credit Corp is a debt collection company with operations in both Australia and the US. It's a stock we held and we were quite comfortable with pre the crisis. We actually sold out around about its first half result, just purely on valuation reasons. Valuation is actually probably a bigger driving factor for the yield sector as opposed to the growth sector we discussed earlier. But now, post-COVID, we've seen a massive drawback in the share price. It fell from where we sold it about 33 down to, at the bottom, I think it was $7 for a single day. We weren't quick enough to move then, but on the way up, we've managed to find this name and really sort of have a look at how the industry structure is playing out for a name, and go back and study what happened in the GFC to debt collection companies. So what originally attracted us to Credit Corp, and it's become even more true over time, is the sort of industry dynamic amongst its domestic names. It's got peers, Collection House, Pioneer Credit, and Panthera, the Australian debt collection companies. All three of them are in serious trouble right now. Collection House and Pioneer have both been a little bit aggressive with some of their accounting policies. We actually put a short into Collection House when we started. It's been holding up relatively well because it's in trading halt, pending negotiations with some of its receivers. But those companies make up more than 50% of the Australian debt market. They've also been a bit aggressive with how they've collected some of the money of those peers, which has really pushed a lot of demand towards Credit Corp. Credit Corp really becomes last man standing in the Australian collection market. It's got a very strong balance sheet. It's actually net cash at the moment. It can deploy that cash with very high returns, especially post a crisis. Now, the chart here we've got here is that highlights this is using PRA Group, which is a big debt collection company in the US. And the returns it generated post GFC were about 50% higher than a normal year. It's because post a GFC type event or a recession type event, there are a lot of bad debts that go through the economy. Creates an increased supply at a time when not many people have access to funding to actually deploy. Now, Credit Corp, with its balance sheet structure at the moment being net cash, is going to be able to deploy those opportunities over the next few years, maybe pick up a peer's debt book really cheap from receivers and grow its market share in Australia aggressively, generating really high returns while it's doing so. It's one of the reasons why we like Credit Corp. Against this,
It's worth pointing out there that it's not just PRA, it's not the US market that experienced that. Credit Corp experienced exactly the same.
It did experience the highest returns it actually received on investment were just post GFC, and we've got the same CEO running the company who was the one who generated those really strong returns post GFC. So there's a lot to like about this name. And against it in the yield space, as we sort of discussed, the relative losers in this space are the banks. Now, particularly Westpac and Bendigo, we've highlighted here. Now, low interest rates just pressure NIMs. You can see overseas in the world that Australia had a relatively high interest rate pre-COVID crisis versus a lot of the other developed markets. And low interest rates have two different factors. They pressure your NIMs, but they also encourage competition.
Net interest margins.
Bank analysts here, net interest margins. They pressure net interest margins, but they also encourage competition from non-bank financials. And banks really have a significant advantage in a high interest rate environment over non-bank financials. Their access to cheap transactional account deposits means they're able to lend at higher margins than a lot of the other players in the system. Now, when interest rates go to pretty much zero, the banks can't keep dropping their deposit rates past zero. Why the non-banks are able to access cheap funding off the debt market, which is looking for yield. So they're under pressure both from a NIM perspective, a competitive perspective, and that's even before we get to what COVID's doing. And we were talking about before about the underlying problems that COVID's been generating throughout the economy. Now, 10% of home loans and 30% of business loans currently aren't paying any interest. The banks are still recognising the income from those due to some generous approaches via APRA around income recognition and capital relief. And APRA's not doing that because the banks are really having a good time at the moment. APRA's doing that because the banks are in serious trouble. And one of the reasons why we're shorting these against a collection house in the yield space is a Credit Corp, not collection house, a Credit Corp in the yield space is that Credit Corp is likely to see higher returns coming out of this recession. The banks are probably likely to see the opposite. I think we're going to end up with a structurally lower return on equity post-COVID, and the banks are likely to trade towards sub 1x book. You see this a lot in the UK and the US amongst domestic sort of retail banks. They don't trade at premiums to book. The Australian banks historically had, but in a low interest rate environment with the pressures they're suffering, I think the game's really changed for them.
Yeah, it's probably a good comparison in the UK where Australia had a pretty good GFC, interest rates rebounded a lot more quickly, helped banks in terms of lending margins, everything else. Offshore, where you've had much weaker growth, very low interest rates for a long period of time coming out of the GFC, you've seen it in the UK, low interest rates just driving down net interest margin, driving down bank return on equity, and they've all gone to material discounts. So the banks might be okay if they stick together, work their way through this, the economy recovers, but it's likely to be with low cash rates. So They're probably not going to knock the lights out for a long time. They've just got that asymmetric tail risk if things don't get better. The leverage from a credit cycle through there and the risks there are very apparent. So we've been waffling on for a little bit now. So one thing just worth touching on here, we've highlighted a few stocks across a few different sectors. As I mentioned early on, one of the key characteristics of our funds, both the absolute return fund and got an example on this chart here, as well as the Equity Plus fund, is we've got a lot of diversification. So we split the market out into 8 broad sectors to help us make more valid comparisons, as we've discussed today, but also to help us control our risks. So we take long and short positions across these sectors. You can see the longs with the dark blue bars, the shorts with the light blue bars. We run very small net exposure positions across those sectors, and that helps us to control our risk, control our exposure to market movements and style movements. What we're really focused on here is having a whole lot of good long and short ideas on companies within these sectors to drive a well-diversified, balanced portfolio, drive consistent returns through different market environments. So we'd be here for several hours if we spoke through. We've got over 100 active stock positions there, over 50 long, 50 short. So it'll take a while to run through everything, but it's giving you a flavour for the way we look at things. That said, might be worth opening up for questions at this stage.
Yeah, thanks, Sean and James. That was great. Just before we move on to some questions, because we've got some great ones here, I just thought it might be worth highlighting how dynamic the process has been this year, given how choppy markets have been. So I thought maybe an example of how you've gone from being shorter stock to longer stock and vice versa, based on stocks being oversold or overbought. Maybe something in the tourism sector, for example, going from March to April and then back to now.
Yeah, sure. There's certainly been some wild changes across the market and the environment there. We're actually pretty bullish on tourism back in January before coronavirus emerged. We had a decent overweight there. Long corporate travel was one of our largest positions. But when we started to see the emergence of coronavirus and that through February, that started to spread around the world. And even earlier, we wanted to cut our exposure to travel and the risk of that new information, how it's emerging. So we cut a little bit of corporate travel back. But we put a short on Flight Centre to hedge that out as well. And then as that pandemic really gained speed, and we started to move toward lockdowns and travel restrictions, and countries were closing their borders, we exited corporate travel through the back end of February through reporting season there, and increased our short and Flight Centre. And that short and Flight Centre gave us some great attribution as the market really melted down through March. But they did eventually raise some money, improve their balance sheet. So they did basically a 1-for-1 equity raise, and we started to see some improvement across the market. We obviously got the liquidity injections from the Fed, some stimulus and elsewhere, and market sentiment improved, and people started focusing a little bit on potential to reopen and recover there. And at that stage, Flight Centre was trading down at pretty low levels, and we saw the opportunity there to take advantage of it from the long side. So we actually went long Flight Centre through that recovery stage, which helped balance out our portfolio within that broader space as well. Flight Centre then recovered very strongly. It basically doubled, went from probably around $7 to around $17 or $18 from memory.
It was just about $15, but with the dilutionary effect of $15, it was back to about 70% of its pre-COVID market cap. And there had been a massive dilutionary equity raising, which you looked at a stock price chart, it wasn't really factored in, but when you actually looked at what the market cap of the company was, it was pricing in some really strong recovery. Yeah,
it's a very good point. And sometimes people miss the fact that when a company does an equity raising there, that wasn't to actually grow the company. We saw quite a lot of this going on. It was just to repair a balance sheet that was hit by a massive shock. So that wasn't really productive capital. It doubled the share count. So that recovery in Flight Centre actually took it to a very expensive position. Then as we start to see, some of the broader spread of the virus around the world, these travel restrictions might be a bit longer dated, more permanent, or if not permanent, last for a few more years. Flight Centre is still going to have some issues and potentially some more permanent changes in terms of the way people travel in terms of business and desire for corporate travel. The ability for what we're doing now, using video conferencing to replace travelling for meetings, and a broader economic recession leaves us a bit more cautious on corporate travel as well, which is a big part of Flight Centre's business. So we've actually moved back to a short position there, and Flight Centre's moved back down in response. That's an example of a company that we've managed to trade around from both the long and the short side, reflecting some pretty extreme volatility in the stock price where it's become overextended in each direction. So we don't try and do that with every stock, but certainly where opportunities present itself, we can be, we're not wedded to necessarily a position on a permanent basis. We do like some things very long term that we hold, but can also trade some of that crazy volatility in the market around as well.
Great, thanks, Sean. So, first question we've got here from Will is, you point out that bond yield shifts may have bigger impacts on volatility. Are you managing this risk in your portfolios? And if so, how?
Yeah, so one of the things we've done, we do within the portfolio is very important in managing risk as well as diversification, is getting the right position sizing on your stocks. So we've done this in two ways. One is reflecting the fact that volatility has just picked up right across the market. So our gross exposure, which is the sum of all our individual stock positions, has come down quite materially. So that's just a way we dynamically reflect overall volatility in the market, what's happening in terms of meeting our risk targets and managing that. The other part of portfolio construction is not just using risk models and measuring volatility and reflecting that, but the investment experience that comes with managing through these different cycles and recognising where risks lay there, and exactly what we're talking about. So the potential for risk to shift in the future if bond yields change, and the sensitivity, the increasing sensitivity of a lot of those high growth stocks to shifts in bond yields. So that's not going to really be captured in historical risk models. That's where the experience of investing comes from. So the easiest way to deal with that is just with position sizing. So when we're looking at some of those stocks in the very high multiple space, and we take positions there, things that we'd like or we don't like, we're just not taking really large positions with them, reflecting both some of their high current volatility, but the risk of that volatility really materially shifts in the longer term.
I'd also argue in the growth space too. That is a grouping that is very sensitive to the bond rate by itself, and we are measuring our overall weight towards that sector, which does neutralise some of the effects we've seen from yield curve steepening causing a big shift to away from growth stocks, or QE-like processes we've seen causing a big shift towards growth stocks. Yeah,
so that sector neutrality helps take that macro volatility risk out a little bit as well.
Thanks, guys. Just a couple of questions on shorting. So the first one's around the liquidity and how you think about shorting, smaller companies, and the other one was around how you think about pairing long positions and short positions. So your example of long app and short seek doesn't seem to look like a connected pair as they're in different sectors. So maybe just if you can talk to that.
Yep. So liquidity is a very strong focus within the portfolio. So we measure average daily volume of all the stocks, and we basically, I was just talking about position sizing, and liquidity comes into position sizing as well. So what determines the size of our position of stock is a level of conviction, expected return, the volatility of that stock, how it fits in with the correlation structure of the market, but also liquidity. So we will constrain our active weights based on the underlying liquidity of the stock, how much volume there is in the market, and that by necessity means that we'll take bigger positions in larger stocks, mid-cap stocks, smaller positions in smaller, less liquid stocks, both on the long side and the short side. Certainly on the short side, borrow availability disappears rapidly outside of the ASX 200, where most of the index money is. that is our core focus, the ASX 200, but we will occasionally look outside there. So James mentioned we put a short on Collection House early on. It's fair to say it wasn't a very big short because it's not a big liquid stock, not a huge amount of borrow availability there. But we did have very high conviction in terms of where its share price was going. So we do match the size of our shorts with liquidity and the size of the shorts. We certainly, if you look at what drives the risk and the return of our portfolio, you do see a sweet spot sort of around 50 to 150 stocks. So the top 50 stocks, their volatility is much lower. It's actually hard for them to contribute as much to risk and return. As you go down, volatility picks up, but liquidity is still quite strong, and that can drive a lot more risk and return. And then as you get down to the bottom end of the market and outside the ASX 200, there can be quite a high level of volatility there, but liquidity drops off, and we try and constrain our risk around those positions a little bit more. I'm just trying to remember the second part of that question.
Around Appen and Seek and a pair.
Pair trades and everything, yeah, thank you. So we don't directly, we will do some pair trades in the portfolio, but we don't look to just build the portfolio up in terms of pair trades because, as the question implies, there's not necessarily, every stock doesn't have a direct pair in the Australian market. There are some stocks that you can pair, like you can pair JB Hi-Fi and Harvey Norman, they're pretty comparable, or Woolworths and Coles, or CBA and NAB. And we'll occasionally do that, but there's a whole range of stocks that are quite unique and they're more difficult to pair. So what we're really looking to do is pair groups of stocks within those 8 sectors that you can see on the previous chart. So there'll be a series of long and short positions within each of those 8 sectors, with the exception of gold, which we've just got longs in at the moment. A series of longs and shorts. So you can think of it as a structure of pair trades, and that gives us a lot more flexibility in terms of actually getting our investment views and value there whilst controlling risk. So you generally put a pair trade on, strip out macro risk, strip out the risk of economic shock or style bias. We do that with our broad risk models approaches, and that sector classification strips out the macro risk, strips out the style bias. So think of it as groups of pair trades within sectors rather than direct stock pair trades.
Right, thanks, Sean. So, I mean, looking at that chart there, the largest net exposure is gold. So we've had a question here about how you approach investing in gold. Do you hold specific gold miners, or is your exposure only to the underlying metal?
Yeah, no, specific gold miners. So our mandate's really Australian listed companies. It's not really, it actually is ASX listed stocks. So we can't own physical gold. Pete Moore, our quant guy, likes reading Zero Hedge. I suspect he's got some gold bullion under his bed. It's possible. But within the fund, it's just gold equities. So
and there was some serious opportunities in the gold space. You'd be surprised at the volatility within gold names and amongst gold names that we found over the last sort of 6 months. There's some opportunities. We have had shorts before on the gold side, being net long, some real pricing discrepancies between different gold names, and we like to take advantage of those. And we do have a few core positions all alongside at the moment, but we have shorted gold stocks before for fundamental reasons, valuation reasons, and we'll continue to do that.
Yeah, generally around production and quality management and those sort of things. So within the gold space, our preferred gold stocks sort of rotated early in the year from Evolution, which was looking very underpriced. There's some issues around water supply at Cal, and with rains that got resolved. The stock price, it's weird to talk about it raining and a gold stock going up 50%. That's sort of what happened. Then Saracen, which had really underperformed Northern Star, great acquisition.
It was very interesting, that one too, because they both owned a large portion in the same mine, but yet the valuation discrepancy was huge between the two. We actually had a feeling that the Saracen management was more conservative and probably a better management ex their main joint mine, but yet the market didn't really factor that in at the time, and they have normalised to a great extent. So there's been a lot of intra-sector movements there that we do sort of definitely do work around.
And now probably St Barbara is one of our preferred gold stocks, where operationally they're starting to deliver, and those things can often last for a while when management get on top of the mines, geology and how they're working, and delivering some upside surprise on production. So yeah, gold equities is how we go there. Probably just touching on, we're overweight gold, but we like that for liquidity across the portfolio. That's balancing out a small underweight there on the growth side. They're both driven by that liquidity central bank dynamic.
Thanks, Sean. Just a question on FUM. So obviously both strategies are, at the lower levels of their expected FUM levels at this stage. But could you comment, I guess, on how you've been running the portfolio to a larger FUM size, and what's the optimal levels of FUM that you'd like to get to for both strategies?
Yeah, so we're early days in terms of starting up. So we've got about $30 million in the funds now, which is good, good growth. But we do have capacity there of over a couple of $1 billion, and we've certainly got very strong experience running that money at that level. It was running $1 billion back at Tribeca, and we had well over $3 billion back at AMP, where I was working for 7 years. So as I mentioned, we structure our fund around liquidity. So we're actually managing our funds at the moment from a liquidity standpoint as if we had $300 million under management. So whilst we've delivered very good returns since inception, as opposed to a lot of other companies that are fund managers that are starting up, that hasn't been by buying specky microcap stocks and huge returns. Those returns have been generated in the large cap liquid part of the market, managed in a way that's achievable with billions of dollars as opposed to where we are now. So
I think we're currently operating as if we had $300 million on our liquidity balance. Yeah.
Yep.
Okay, great. Thank you, guys. Last question. So this is for you, James. So question about Credit Corp specifically. So it's saying that Credit Corp had a few legs down after the GFC fell 90% before the stock price went up on an upward trajectory. During the current crisis, it's down around 50%. What's different this time? Is there any more pain to come before it gets better?
Debt levels, the main thing that was different at that period of time. The company went into the GFC with debt levels to its PDLs around 70%. And the securitization market, as you're well aware, closed up during the GFC, meaning that there's a lot of concerns that they wouldn't be able to get access to any more funding, and they may struggle to either make new purchases, service their existing debt, be called in on the new debt. That really isn't the case anymore. As I discussed, they are now net cash. Even going into this crisis, they were sort of towards the bottom end of their gearing range. A lot of their peers that are struggling at the moment were towards that 60 to 70% level. And that can cause some issues when you do have a freeze up period like we've just seen before. Credit Corp recently updated the market, took what I believe to be a pretty conservative approach to their guidance for the next couple of years, sort of talking about unemployment rates of 15% is sort of their go-to for how they're sort of seeing the market in the next couple of years. That's very aggressive, and even with that, their collections efficiency was actually surprisingly positive from that update. So we're very excited about it, and we believe that what you're going to see the same dynamic as you did see in GFC, where the company will come out stronger and returns will go up even greater than they were previously.
Great, thanks, James. That's about all we've got time for, so thank you very much for your attention this afternoon. We've got a couple of questions which we'll get back to people on after the call, so thank you for your questions. I'm sure most of you on the call are aware, but if you have any questions at all, the contact information of the Channel Capital team are on this slide here, so please reach out to your distribution director as you wish. Thanks again, and have a great afternoon.
Thanks, everyone.
Thank you. Yeah, thank you, everyone. Thanks for your interest and enjoy the rest of the day.